So, you turn 73 in 2026. You feel fine, nothing dramatic happens, but the IRS has been watching the calendar. At 73, you are required to begin taking money out of most retirement accounts. These are required minimum distributions, RMDs. The government has waited long enough, and they want their money. Since you turned 73 in 2026, your first RMD must be taken by April 1st, 2027. That sounds generous. It's not. If you wait until April 1, 2027 to take your first withdrawal, you must also take your 2027 RMD by December 31st, 2027. 2 distributions, same year, both taxable. That can push income higher than expected, higher tax brackets, higher Medicare premiums, more of your Social Security tax. No one likes that surprise. The math itself is mechanical. The IRS uses life expectancy table. At age 73, the divisor is 26.5. So if your IRA balance on December 31st, 2026 was $530,000, you divide that by 26.5. That produces about $20,000. That $20,000 becomes taxable income. Now, your brokerage firm already knows your birth date. They already know your balance. They can calculate this instantly. They should be contacting you before the end of 2026, explaining your projected RMD and asking whether you want to take it in 2026 or wait until 27. You should not have to remind them. Most traditional retirement accounts require RMDs. Traditional IRAs, SEP IRAs, simple IRAs, 401ks, 403bs, old employer plans. Roth IRAs do not require RMDs during your lifetime. And beginning in 2024, Roth 401ks also no longer require RMDs while you are alive. If you are still working in 2026 and you do not own more than 5% of the company, you may be able to delay RMDs from your current employer's 401k until you actually retire. That exception does not apply to IRAs or old plans. Those distributions still required. Miss an RMD and the penalty is 25% of what you failed to withdraw. If you were supposed to take $20,000 and you did not, that's a $5,000 penalty. It can be reduced if corrected quickly, but it's paperwork and aggravation. Most large firms offer automatic RMD services. They calculate it each year. They distribute it on a schedule. They withhold tax if you request it. It runs quietly in the background. That setup should happen before your first deadline ever arrives. Now, here's the part many people overlook. If you're age 70 and a half or older, you can use something called a qualified charitable distribution, a QCD. Instead of taking your RMD, paying tax on it, and then writing a check for charity, you can have your IRA custodian send the money directly to a qualified public charity. Directly means directly. The check must go from the IRA trustee to the charity. If the money comes to you first and then you donate it, it becomes taxable, and then you have to deduct it on Schedule A. When done properly, the QCD amount is excluded from your gross income, not deducted, excluded. That distinction matters because reducing adjusted gross income can affect taxation of Social Security, Medicare premium brackets, and other income-based thresholds. For 2025, the annual QCD limit is $108,000 per person. If you are married and both of you have your own IRAs, each spouse can exclude up to $108,000, so potentially $216,000 excluded on your joint return. There are limits. The distribution must go to public charity, not a donor-advised fund, not a supported organization. You cannot claim a charitable deduction for a QCD on Schedule A. The benefit is exclusion from your income. And if you receive goods or services in return for the gift, such as dinner or an event benefit, you must subtract the value. The full amount must otherwise qualify as a charitable deduction, but that's no different than what you've been used to on your Schedule A for charitable deductions. There is also one-time election. Up to $54,000 in 2025 can be directed to fund a charitable remainder trust or a charitable gift annuity and treated as a QCD. Another important point, you can begin making QCDs at age 70 and a half. RMDs do not begin until 73. That means you can reduce your IRA balance before RMDs ever start, which lowers future required distributions. So if you turn 73 in 2026, the conversation your brokerage firm should already be having with you sounds like this. Here is your projected RMD. Here is the tax impact of taking it this year versus next. Here is how QCD could satisfy all or part of it. Here is how we set up this automatically so you never miss it. They have the data. They have the systems. This should not be reactive. It should be automatic. At 73, the rules are predictable. The only thing that should not be is a surprise.